Well, finance research brings another very important topic for our CA, CS and MBA finance students, which is known as greenshoe option. Usually this is related with the capital structure of the firm. When any company that constructs its capital structure through equity, so they launch their initial public offering in the market, in the primary market, and then they hired some merchant bankers or the investment bankers to for the purpose of the price stabilization in the secondary market. So we will just quickly take a look what is about the green shoe option and why is this called as a green shoe and what is the role and significance of the green shoe option. So here we will just quickly see the term green shoe option is basically derived from a company for the kids shoe manufacturing from the United States that was founded during First World War. So they hired some merchant bankers in order to stabilize their prices in the stock in the secondary market. Company still exists, now known as a Stride Right Corporation. Green shoe option is basically underwriting agreement of an initial public offering of a company that allows the merchant bankers, which are known as underwriters. They can borrow up to an additional of 15% of the company's shares at the offering price. That means the total IPO size. For an example, if company has the IPO size of 1 million shares, okay, there must be some price band determined by the underwriters. They mention in that their red herring prospectus. So out of the 1 million share, so that means 1,50,000 shares they can float in the secondary market in order to stabilize. And how do they do it? They do it through the over-allotment of the shares. When the public demand for the shares exceeds, actually there are two things here. So usually there might be two things possible in the secondary market after the IPO comes in the secondary market. Maybe the public demand for the shares exceeds expectations and the stock trades above the offering price. If there is an inflationary trend, for an example, some retail investors, they might not have an access of the shares which is now trading in the secondary market, so they will create undue demand because of the fundamentals, or they think the intrinsic value of the share that may get some benefit in the future, so they create their demand in the market, so the prices tends going up in the market. So there is a irrelevant inflationary trend because there are no fundamentals of the company, because the first time they have launched their IPO in the market, and the retail investors are thinking, they have their in mindset that the company will be proven as a futuristic prospects for that share. So they create a demand in the market. So those retail investors who did not receive the shares, they also tend to buy those shares. Actually what happens, for an example, company has a IPO size of the 1 million shares, right? And there are 4 million or 5 million applications they receive. So on the pro rata, usually what happens, because they have an agreement with the underwriters, and those underwriters are known as the merchant bankers or the investment bankers. So they try to provide these shares on the pro rata basis to all the applicants to some extent, but still there are some applicants who are left who received no shares in this pro rata basis. So they are also interested to buy those shares. So that is why after listing in the secondary market, they create demand in the market. So what actually underwriters do, if IPO is a success means if the demand is very much high, and obviously the supply is 1 million shares, that is limited. So the prices will go the bullish trend, and the prices are going to surge in the market. So they have an option within 30 days from the date of allotment of shares. They can exercise their option by over allotment of 15% share which they borrow from the company. So with some example, I have illustrated through one example also. I have taken a company of the Facebook which was launched in 2012. They went for the IPO. So we will just take a look after that. Okay. These promoters or pre-issue shareholders which have more than 5% shares may lend their shares to the merchant bankers in order to stabilize the prices. So obviously they will open a GSO demat account in which the shares will be 15% shares will be transferred, okay, for further over-allotment or the buying and selling in the secondary market. And whatever the money received in this transaction will be deposited in the GSO bank account. This GSO bank account is actually the escrow account, because this is the intermediary account between the party, which is a company, and the stakeholders, and those are the retail investors. Underwriters use greenshoe options in one of the two ways. First thing, if the IPO is a success, as I discussed previously also, what will happen? The share prices of that company will start moving up. There will be an exceptional bullish trend in the share market. So company doesn't want this, that without any performance, without any fundamentals, without any balance sheet or the profit and loss account, because soon after listing in the secondary market the prices are going to up because of the undue demand from the retail investors who did not receive the shares on the pro rata basis. Then the role of underwriters or the investment bankers come. They exercise the option. What will they do? They will either buy or borrow the extra stock. What is that extra stock? That should not be more than 15%, because in SEC or in different countries there are some regulatory bodies. Okay, so they monitor each and every activity by the company and the activities of the merchant bankers or the investment bankers. So only 15% of the IPO size can be done in order to stabilize the prices in the secondary market. So what they do, they issue those shares, those 15% shares, as a part of over-allotment in order to reduce, in order to enhance, in order to increase the supply of the shares in the market, so that all the stakeholders or the retail investors will start, there will not be scarcity, there will not be shortage of supply of shares. So they enhance the supply of the shares in the market. If they enhance the supply, if there is a more supply, and in an equilibrium of the demand of the shares, so the prices will not shoot up, will not show the bullish trend as they were showing, because of the limited supply of the shares. Okay. Conversely, there may be inverse action also. If the prices starts to fall, for example, the IPO is undersubscribed, so what will happen? What will happen in that case? The merchant bankers will not borrow 15% shares from the company and do the over-allotment in the secondary market. Instead, company will take the short position. What is the short position? Short position is something related with the short selling. Okay, they will borrow instead from the company, they will borrow from the stock exchange or from their brokers itself. So they will borrow 15% of the IPO size from the broker and sell at the CMP at their current market price. Intent, the prices will go down. Okay, so obviously the prices were going down. So in order to stabilize the prices, firstly they sell out their they do the short position, and then supporting the stock to stabilize its prices by buying back those 15% shares, and there will be, the margin will be their profit. Obviously the profit will be transferred in the escrow account, which is not the profit of the merchant bankers, or the profit will not go towards company itself. There are the regulations, there are the monetary bodies, because these are the actions which are done for stabilizing the stock prices in the secondary market. So this will go in the some different account determined by the regulatory